What's going on, guys? Welcome into today's episode of Money Moves. We got a lot of exciting topics to dive in on. Right now, the economy looks stable on paper, but we're seeing some uncertainty hitting record highs. Housing demand is fading. We've got some long-held investing assumptions that may be quietly changing how investors are looking at the market. Today, we're going to dive in on the AI boom that could break the economy, record global uncertainty, and what markets historically do next. Tariffs from Trump's big ruling from the Supreme Court last week, recapping all of that and how he responded. Why older Americans now drive nearly half of consumer spending. Americans working 2 full-time jobs. Is this the resilience of the American consumer, or is this a warning sign? A potential gold black swan scenario. Housing demand quietly weakening beneath the headlines. The psychology shift happening among home sellers right now. We've got a lot to dive in. Let's get to it. Welcome. We've got a great episode today. As always, your host, Maddie A., my co-host, Mr. Breedwell.
Howdy, y'all. Oh, I'm doing good, except, if anybody's listening to this, if you're listening, I'll be in Austin this Thursday through Monday. It's hard for me to connect with a lot of my people, so I'm just throwing it out there. If you have my cell phone number, let me know if you're in the area. It might be cool to link up. Sorry to take that little detour. Doing good. We had fun time in Truckee.
Blast.
Holy cow.
Record snow up in Lake Tahoe. It was nothing but beautiful pow up there.
The houses looked like
up there.
Gingerbread.
Yeah, it was.
They looked literally like gingerbread
lots
houses.
of sledding, tubing. Man, I had so much fun with my girls. So thank you for inviting us up there. That was
Good time.
We had just great time with you guys. Great time with all the kids and families that were up there. It was fun.
Good.
Man.
It was really good.
A lot of good food, a lot of good wine.
Oh, yeah.
And some good memories. So getting to check a lot of those boxes, being out in nature, one of my favorite things. Tahoe is just one of a kind. So that was a great way to finish out last week, kickstart this week. And we've got a lot of good stuff to dive in on this week. First and foremost, why don't we talk about just the overall market, how things are going from your perspective this week? Just get some of the housekeeping items out of the way. We've got earnings. Big one this week is Nvidia.
Yeah, I would say
our biggest.
I would say from non-political stuff, like, just pure financial information, that would be the catalyst of the week.
Yeah,
that's my opinion. I think that most people would agree. The size of that company can move momentum from one side to the other. So I think that Nvidia's earnings this week is the big financial catalyst. Flipping that on its head tonight, and by the time you listen to this tomorrow, we're talking Tuesday night at 9 p.m. Eastern, 6 p.m. Pacific time, I believe President Trump is giving a State of the Union address where he may announce, and it's, I'm not looking at call share poly market because I haven't, but I feel like it's highly likely he's going to announce military action, at least at a moderate level, or to begin at a moderate level in Iran. And I don't think the market is going to be upset about that. I actually think it's going to be the opposite.
It seems like it's always been relatively well absorbed with conflict in the Middle East over the last few conflicts.
War is very good for the U.S. economy because we don't lose them really anymore. We either just stop fighting them or we win. There's really not losing. We just spend, but all of it is spending money, and the companies that they spend money with are publicly traded. So it all translates into stock
The
prices.
industrial war complex. Whether you like it or not, it is a dark underbelly of the capitalist economy of America.
The flip side to it, though, is like a China.
Conflicts.
So like there's not really a great model for war preparedness. But I would say that at least if the public can benefit from a monetary perspective, which they can and do, by buying U.S. aerospace and defense sectors, my opinion would be if we get that announcement, we'll see a heavy rotation. I don't know where. I would think it would come from healthcare and probably healthcare and precious metals and commodities into U.S. aerospace and defense, and maybe some AI stocks as well, because we have the likes of Mr. Palmer, we have the likes of Palantir. Those are defense stocks. Or excuse me, what's the company? And
Anthropic.
Anthropic. Thank you. We have all these AI companies that present as AI, but Palantir is a defense company that's with an AI twist to them. That's their data to procure a advantage over somebody else, which is a defense stock in a way, in my opinion. But those are going to be the areas that I think are going to benefit from that. We should see oil prices spike pretty sharply, which is not going to be fun. You know, I've been really enjoying seeing the 3 and the 4 flip on the board down here for gas prices. But this is where some energy sectors will benefit. The consumer is the one that's going to not benefit, though. And to remind everybody, high oil prices is an inflationary data point. So these are things that we want to kind of, in the short term or in the mid and near term, not a huge deal, but not really great for the consumer, especially on the gas prices going into summertime here in the next 3 to 4 months. But time will tell. We'll see what happens. I think it's going to be really good, though, to see the rotation spread out into U.S. aerospace and defense from the concentrated sectors right now, which is energy, industrials, and then growth stocks and tech, which is AI.
Now, let's shift over to kind of this narrative of uncertainty, a lack of optimism some people are showing, tied in with some of the data, economic data that we've been seeing, and whether or not, you read in between the tea leaves and tell us what your thoughts are.
Sure.
In a recent Gallup poll, U.S. optimism amongst adults about their future has declined to 59.2%, which is the lowest ever per Gallup since they started doing these polls decades ago. Then you also have the U.S. economy is now reliant on older Americans like never before. Americans age 55 plus now represent 45.3% of all U.S. consumer spending, the highest in at least 28 years, showing the lack of consumer power amongst younger generations. A big part of that data set was around the lack of earning and their wage growth. That's nearly double the 28% seen in the early 2000s. By comparison, those age 54 and younger are down to just 54.7% from 72% in 2000. So the gap between the two groups has narrowed pretty significantly by 35 percentage points over the last 25 years, and is on track to converge for the first time in history. This comes as 73.7% of all U.S. wealth is held by those over 55, which is up from 56% in 2000. So what happens to economic growth when spending increasingly depends on retirees instead of some of the younger generations? And I guess what we're seeing is like their waning strength. Is there any concern about this short-term, long-term, how it impacts the stock market, the economy as a whole?
I would disagree with that being an issue. Because retirees are typically always better spenders than the working force, and they spend their money in different areas than the working force does. They support leisure, travel. A retiree is simply going to buy other things and spend money in other areas than somebody who is a non-retiree is going to do. So that's one of the reasons that they don't really mess ever with Social Security benefits, because taking that money away would hurt the economy more than it would help not pay Social Security benefits to retirees. Kind of coming back to it, in 10 or 15 years, that narrative is going to switch, except it's not going to be the boomers. It's going to be millennials is now. And why? Because they're inheriting money from their parents. And it's going to be more wealth than those people inherited and just going to compound forward. It's always going to be the inheriting age generation, which is late 30s to early 50s. And that age will kind of get a little longer as people live a little bit longer and people, don't die at such young ages. So that statistic is kind of moving in the right direction. Gen Z is cooked, so I'm not really worried about. The majority of them have such a skewed view on the world. They're kind of like really a lost generation. It's gonna be like this huge dip on a chart, and it's sad because a lot of it's due to COVID, mismanagement of kids through parents getting bad information, everyone's being force fed a bunch of BS, and then having to rewrite the script about 4 or 5 times over multiple years. But I would skip on to Gen Alpha, like our kids.
Yep.
And they're looking pretty strong. Gen Alpha looks good. They're kind of center right from what I've seen for polling. Who the fuck does Gallup poll, by the way? Have you ever seen a Gallup poll?
No, I've heard of the name.
I've heard of the name
who
too.
they actually
I don't know who they poll.
Yeah, I'm not sure.
No idea. I've never. Gen Alpha is kind of like the saving grace. Gen Z just does not have good, really anything. They're not bad kids per se, but they just don't have a great. They went through. They grew up through COVID. And a lot of them kind of got screwed with and brainwashed by a lot of the stuff when they were their most vulnerable. And a lot of it's not fixable anymore. But I think that the Gen Alpha is going to change the script and look a lot maybe like our parents' generation did when they were going through high school and they were going through college. Way more responsible, more community focused, focused on things that matter, just not wrapped up in so much of the BS. And it's because the people that are parenting them are the first generation that got both a little bit of tech, like we talked about, and a little bit of the old school vibe, right? I got a cell phone when I was like 16 years old and I still wasn't allowed to text on it. So like not being able to text, I don't even think is a possibility nowadays. It's just standard, like when I was growing up, dude, that was a separate plan. Like you added texting. It was like a separate addition that you added to your plan. So like we didn't have that kind of stuff. The way I found out what I was doing is whose yard or lawn's got the most bikes, baby. Whose parents ain't home after school.
Right.
So that generation being able to imbue both of those is really good versus Gen Z getting raised by a generation who's hyper pushed into tech they've never really experienced, trying to be modern, trying to be friends and parents, but really end up trying to be friends because their kids are so kind of wild because they have so much tech and things are moving so fast, they never had a taste of it.
Yeah.
So I'm not worried about that. But the statistic will always be that the inheriting age generation has the most spending power. You and I will have more spending power than our parents did at their age, or we should, assuming that they're successful because their assets kept growing, they used them, and they gave them to us. And then when we get those assets, we let them grow, we use them, and we give them to our kids. That's a generational wealth wheel.
Yeah.
And that's, America hasn't been in the position to kind of have that, minus really starting in the 70s and 80s. That's really when people could democratize their wealth. They could invest in stocks. They could invest in mutual funds. It started to be easier to put their money to work through real estate, the real estate boom in the 70s and 80s. That type of stuff didn't exist in the 20s, 30s, where you inherited a house pretty much or a business. It wasn't like what we have today. And adding on to that, you and I have crypto. You and I have, probably tokenization of assets that we could never think about tokenizing. So we have a lot more opportunity to put that money to work, and the velocity on it just keeps getting faster and faster. It's faster.
Yeah, it's a great point. I mean, you kind of alluded to it a little bit of, I think a big portion of this global uncertainty is, you talked about the velocity of new things kind of coming down the pipe, and it's like people are drinking through a fire hose, and we're so connected in a way that we've never been connected. Like people used to worry about what was happening maybe in their neighborhood. maybe in their city, maybe in their county.
We're about
But
to find
now-
out tonight of what's happening in the world.
That's what I'm saying. Like now we're seeing bombings happen in front of our screen, in our hand. 20, like the velocity of information, the access to information, stuff that just wasn't as readily available as it is now today, I think is a proponent of, I just saw this. The World Uncertainty Index hits a record high, surpassing COVID, the global financial crisis, and the dot-com bubble.
I would be bullish on that.
And okay, so
From an investing
perfect.
standpoint.
So this leads into my question, right? Which is, does extreme uncertainty, right? We talk about the fear and greed index, and historically, if you look at when fear is at an all-time high, or the fear indexes call it as low as it can go, which means it's really, really high. Historically, that was the time you wanted to make some investment moves, and looking back in hindsight, you're like, that was the bottom, or it was close to the bottom, or it was, right, like a sentiment that everybody was stuck in their tracks and smart money was really making moves behind the scenes, and they were buying and getting positions that made a ton of financial sense in hindsight. So does extreme uncertainty historically create risk or opportunity for disciplined investors? And how do you think that ties into the sentiment that many people are feeling right now?
Well, you should ask Warren Buffett, and he's going to tell you it creates opportunity. That's one of his most famous quotes is, when there's blood in the streets, buy, 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 buy.
Mm-hmm.
I wouldn't say there's blood in the streets right now, but people are acting like there is. So I would give that moniker a tip, and I would say that's probably what I would be doing, and it's what I am doing. Federal Reserve Bank, I'm looking at the 12-month rolling recession probabilities. Federal Reserve Bank of Cleveland, 16.1%. New York Fed, 20.4% for a recession by December 2026. Y Charts has recession at an 18.78%, and the S&P Global Ratings reduced their recession probability from 20 to 25, down from 30% over the next 12 months. So the thing about that is
it's weird how the feeling and the actual facts, I guess, aren't necessarily
that's really what
aligned, right?
But that's why I know nobody knew 2008 was going to happen, or they wouldn't have continued to go down the path. The scene in that movie, the Big Short, where they're talking to the two mortgage brokers, the young guys, are like, "Oh yeah, we just go get him another mortgage, and they're literally like openly talking about fraudulently issuing loans, but they don't see an issue with that. What's wrong? Everybody pays their mortgage, and everybody can pay their mortgage. No income, no job, no problem. That would never. I mean, you know better than I do. It's not happening now. But nobody goes into a problem and says it's a problem, so everybody know about it, and there's going to be no problem.
Yeah,
a problem happens because everybody thinks no problem is going to happen, and then they find the edge of the cliff, and they don't know until they're already there. That's what happened in 2008. That's what happened during COVID. That's what happened in when we had runaway inflation and interest rates under the Biden administration with that rolling recession from 2022 through 2023. Nobody knows it's going to happen.
Yeah.
So I'll remind everybody, the easiest thing to do is say something is going to go wrong that people want to go right. Because nobody's going to be mad if that thing goes right and you said it was going to go wrong. If you said it was going to go right and it goes wrong.
Mm-hmm.
So it's easier to be a bear. It's harder to be a bull. And I'm the perma-bull. I'm always bullish on something because there's always opportunity somewhere in the market. Just because the market's going down does not mean that that's a time to get out. Quite the opposite. Where can I double down on quality? Where can I put money to work that was maybe in an area that, no, probably for the next 12 months, it's not going to be working very hard for me.
Yeah.
That's what you do in times of volatility. The worst thing to do is how people are taught and pushed to think by media outlets. And go look at Jim Cramer. Like, what if you would follow his, and people do, what if you followed his investment advice to a T? What if you followed mine? Who'd be more successful? And I'm the one saying not to do what they're telling. You'd make a lot more money on my side. Being I'm forgetting the word, but doing the opposite of what the... Contrarian, thank you. Being a contrarian investor is hard, but it is highly successful habit. And me and my team try to be a contrarian, and we ignore headline news, focus on data, focus on quantifiable outcomes and reality, not just what we can assume ourselves into a corner. And I don't think there's going to be a recession. There's just no reason to be. If there is, we'll go bomb Iran, and then there's going to be no recession. I mean, I know that sounds stupid, and that sounds like, oh yeah, that's probably what would happen.
Right.
So it's just not
They
going
would
to
stimulate it some way.
Yeah, it's just
Well, what are your thoughts on, again, we know the big part of what drives our economy, what drives businesses, shares is the consumer, right?
It's always. That's why small businesses they're so overlooked, but they're quite literally the foundation and backbone of the U.S. economy.
So let me play this out for you, because I thought it was just a really interesting article that it went viral all over X. It had something like 55 million views within 48 hours. It was pretty interesting article, and it had all kinds of great, discussion and dialogue around it. I think, it might be a little bit extreme of the realities of what people think AI is going to do disruptively to the consumer and just the average citizen. Because right now we have Americans, this is a fact, working 2 full-time jobs, hitting an all-time high. So, I don't know, is this economic resilience, or is this an affordability crisis and the cost of living versus real wage growth and people being able to keep up with just life is becoming harder and harder? And this is just one fact today, but this is the scenario that I want to play. I'm going to give you a summary of this article, okay? So this was the AI boom that could break the economy. And I'm going to summarize. It was a pretty long article. You can look it up. AI is massively increasing productivity. We can agree on that in some ways, right?
I was gonna say I have a rebuttal cooking in my head, and it revolves just around. That's that sentence is gonna be 80% of what I say.
Okay, so AI is massively increasing productivity, but it's replacing human income. So companies can now produce more with fewer workers, which boosts profits, but reduces the number of people earning high salaries. The real risk isn't AI failing, it's AI succeeding too well. If millions of high earners lose income or take pay cuts, consumer spending drops, and spending is what drives the economy. This creates a dangerous feedback loop. Companies replace workers with AI, consumers spend less, companies earn less, companies invest more in AI, more workers are replaced. Entire industries built on friction are really the most vulnerable right now in the short term. Real estate, companies, insurance brokers, travel booking, middlemen, payment networks, right? They kind of went through this whole list. AI removes a lot of that friction instantly through what it does. So this could hit housing, it could hit credit markets next. If high income workers lose earning power, even prime borrowers may struggle with mortgages, not because loans were bad, but because incomes disappeared. Wealth shifts dramatically from labor to capital. The winners are those who own AI, compute, and productive assets. The losers are those who rely purely on selling their time. The biggest insight is AI can be bullish for stocks and technology, but it can be bearish for the broader economy and the average consumer, because machines don't spend money, people do. The takeaway is that the future belongs to those who own assets, own infrastructure, and leverage AI, not those who compete against it. And again, this is me really trying to condense that into, but again, right? I mean, that's kind of what I've been thinking in my own head of going, the way to make more money and drive more profits to shareholders is to reduce OpEx. It's to drive margins. It's to increase shareholder prices, right? Inflate values of companies. But if you have less bodies working in these companies and it's more technology and more people now are losing income, where does that income really get made up at scale that exponentially AI is producing and replacing from a human capacity? And if you extrapolate that out over 5, 10, 15, 20 years, what is it going to look like for the middle class or the lower income workers that are not smart money, don't have access or skill sets to take advantage of these tools? To me, it's the rich get uber wealthy, right? Big companies, get much bigger valuations. But at some point, there's going to be a diminishing return of who's going to be spending money at these companies if the average consumer doesn't have that spending power like we've had for so long based on the human economy that the American, economy is.
Well, a lot to unpack there.
Yeah, what you got
I
for
think that it's hard to get out of our mindset of thinking that a company needs the same amount of revenue to meet the same profitability if they don't have, for example, people to pay, just machines to manage.
Sure.
So, it's kind of the sliding scale where, we're getting rid of a outdated working style and replacing it with a more efficient one so that we can get productivity more streamlined so that we should be able to get those products probably for cheaper, I would hope. Or they can stay at a similar cost and not have to rise so fast in cost because there's not the support system that is normally built into that. We don't have healthcare to pay. We don't have retirement stuff to do. We can just invest it into the product. So the product quality will probably go up.
Agreed. I don't disagree there.
All the other stuff, it focuses on a potential negative of it, but I think that would breeze over the non-potential, like factual positives of the only reason we're even talking about it, because it would do this and it would do this and it would do this and it may do that, but we don't know. But what else do we have technologically that would be a huge jump? And what did it replace? Cell phones. Pretty much got rid of landlines. It didn't kill the telephone industry though. Pacific Bell just got purchased by AT&T. And now AT&T is one of the largest wireless providers. And that infrastructure that was laid in the ground was used by Comcast. And now we get TV over those versus telephone calls. What's another one that I can think? The car, we talk about when the combustion engine was invented. When airplanes were invented, the train didn't go to bust. Yeah, people don't use trains now for transportation very much, at least in America. They primarily use them for industrial transportation or transportation of goods. But it didn't kill off trains. Just people figured out and transitioned to a different industry. And I think it would create other jobs that we're not giving credence to as well, that would need human input. Humans will need to repair those machines. Humans will need to manage those machines. Those machines will need some other thing that we're not thinking of. And so it doesn't just rob from one area and then not replace it. It's not like drinking a cup of water. It's like pouring out of a vase into multiple cups. The water is not gone. It's just dispersed into different vessels. And in this case, it could be maybe dispersed more efficiently than just being in this one vessel like we currently do it now. And I think that AI is going to do that. Having said all that, people have to get with the reality that, we're not going to do things eventually like they are done now. And that's not like bad and it's not scary. It's just the way that things go. We don't do things today how we did things 10 years ago. So it'd be foolish to think in 10 years things are going to look like they do now.
Yeah.
So you have to adapt or you're going to die in a capitalist economy. And the idea that pops in everybody's head, I think, is like the farmer or somebody that works with their hands. That person is going to need to adapt or figure out a different area to work. It sounds harsh, but if I was that person, that would be the truth for me. And just because I'm not that person doesn't mean that's not the truth for them. So that's just the way it is. People that were horse farmers and buggy creators, and train makers and elevator designer. I mean, think of all these industries that had their huge boom and then went through changes, with a bust. And they're still here. They're just not like they were. They're shells of themselves, and they probably eventually will go away. But those people had to adapt, or they were going to die. And most of those businesses just figure out a way to adapt. And most people that are successful figure out a way to adapt.
Yeah, I mean, I think the game is changing for sure. And at the end of the day, if you're playing to win the game, especially the wealth game, like the writing's on the wall. You got to lean in on these tools. You got to understand the technology. You got to understand the risks, the threats to whatever it is that you do, the opportunities and how you can leverage it. I still do think that this is a different reckoning of technology and how it implements exponentially in ways that I do think the wealth gap is going to increase pretty significantly. Elon Musk even said this You've heard big bankers say this, that we're not far off with seeing how AI is being implemented into the world and is going to continue to get implemented, with the reality that UBI, universal basic income, will be a reality that does come to our doorstep sooner than later. And it's going to be because some of these things. Elon Musk even said it recently that, there's no point in putting a significant amount of money into retirement in 30 or 50 years if you're a younger person, that you should be investing it in different types of assets and, this traditional model, because a lot of stuff is going to be a lot cheaper and deflationary and things like that, right? So it's interesting. I do think that, it's really hard to extrapolate out a lot of these ideas and think, like, how does it really get absorbed into the world we live in today? But I can see some of these theories play out in a way that if, the poor or middle class communities don't find ways of making themselves more valuable in the economy that is leveraging this technology at such a rapid scale, they're going to be like, I don't even know how to compete. I don't know how to play this game, And so that's where I think it'll be interesting to see, but time will tell, right? And and again, like I said, and like you said, at the end of the day, we're all trying to play a game of just living a better life. I think technology and AI is going to make life better in a ton of ways, but there's that wealth component that you want to be at the top of that game, right? And so you got to understand what's going on. You got to build the skills that allow you to leverage it in a way that helps you become sharper and have a better probability and chance of winning. And that's why I think all I'm saying there is not to scare people, but more so just to say, like, shit's changing, and just make sure you're part of the conversation, because if you're not, it's going to be too late, right? And you're just going to be behind the 8 ball. So let's talk about real quick on this last week. We've been talking about it for a couple months now. Supreme Court ruling on Trump's tariffs.
I finally
they got into the mix.
Something with Trump correct.
They got into the mix, and the Supreme Court, our judicial branch, got involved in overruling the executive branch and told him that he could not do that.
They did say that.
They struck down President Donald Trump's global tariffs. And this last week, I think it was Scott Bessent got on and basically said that the court did not rule against this administration's tariffs. It only said IEEPA, that acronym, can't be used to raise revenue. He said, we will immediately shift to other proven authorities. He listed off a bunch of sections. Let's give it a quick listen in what Scott Bessent said immediately after the ruling.
Take a moment to address today's Supreme Court ruling, and I would note that I did not change a single word in my speech post the ruling. President Trump will always put our national security and Americans first. And as I have said before, the president has multiple tools in his toolbox. Let's be clear about what today's ruling was and what it wasn't. Despite the misplaced quoting from Democrats, ill-informed media outlets, and the very people who gutted our industrial base, the court did not rule against President Trump's tariffs. 6 justices simply ruled that IEEPA authorities cannot be used to raise even $1 of revenue. This administration will invoke alternative legal authorities to replace the IEEPA tariffs. We will be leveraging Section 232 and Section 301 tariff authorities that have been validated through thousands of legal challenges. Treasury's estimates show that the use of Section 122 authority, combined with potentially enhanced Section 232 and Section 301 tariffs, will result in virtually unchanged tariff revenue in 2026.
So he basically said, hey, look, we kind of were planning for this. We had a bunch of other potential options, to put in place if this was something that happened. And as a result of that, I think within hours, Trump came out and said, yeah, that's cute, Supreme Court. I appreciate your opinion here, and we'll follow that rule. And at the same time, he went on and imposed a 10% global tariff on all countries and says that tariffs will remain in place despite the Supreme Court ruling. So,
oh God, I'm just weird.
how did the market respond to that? First off, like, did it go up, go down?
It went up. It went up, and then it went down quite a bit the following day because it was like, oh yeah, well, no, Trump still has authority on. Sounds like Trump is still. They essentially went, yeah, the Supreme Court's going to make the final decision, so the market went up, and then it was kind of swallowed pretty quickly. That was like, no, this is going to get challenged. It's not going to go anywhere for multiple years, and it's likely not going to ever get ruled on. It'll probably be the ruling rescinded, and they'll have like a non-opinion, or they might rule the other way and agree that, yeah, you can't put tariffs in this way, but he can put them in the way that he's applying them, so he was never actually wrong. And that's what I think is going to happen.
Yeah.
And because of that, the market pulled back and said, okay, because essentially the market is saying we don't have to worry about Trump saying something to another country and us freaking out.
Yeah.
The whole thing that was happening pretty much all of last year. And so that's still baked into the economy. And so now people have to be very careful on what he says because it does move the market so much.
Yeah, well, it'll be interesting to see if he says anything tonight and how the futures.
If I think it's just
what he says tonight.
Yep.
Now let's talk about gold, precious metals. Obviously, been on a pretty historic tear as of I think earlier this morning there was a pretty big pullback.
Huge pullback.
Any reason for that, or
I just think it's a continued rotation out of precious metals into areas that have more potential upside and more long-term use. We did get back into the 5,000. I think it's like 51, 5160, 5170 or something on gold right now. So we're back above 5,000. We were in the 4,900 range for a while, but it was just so overbought and there was a lot of hype behind it that wasn't really finding footing with a lot of people. So I think that is starting to kind of bake in as a reality with people. I'm not seeing a lot of dudes in their RVs flaunting their silver bars anymore.
That was great.
So,
I mean, what are your thoughts on? And again, these are when I bring this stuff up, right? It's just to stir the pot a little bit. But I think a lot of people, we've heard the BRICS conversation, we've heard the U.S. dollar, weakness and the concerns around that. Being the future of the global reserve currency. Like, is there a scenario and any potential theory that governments and banks are piling into gold right now, i.e. some of its historic run, because we're going to move off of the dollar as the global reserve currency and go back to the gold standard?
No.
Okay.
That'll never happen.
Ever.
Okay. You heard it. I said it. Ryan Breedwell. Never will happen. There's not enough gold. It would be like there's not enough gold.
Well, let's talk about this black swan scenario that Tom Lee talked about on a podcast this week about maybe there is more gold out there and this could lead to a black swan event. Let's listen in.
What I'd call black swan risk to gold. One is there's 1 million times more gold underground than above ground today. And so if gold gets too expensive, like literally Mag 7 is just going to get into the gold mining business, right? Because you might as well just dig for gold. It's more valuable than anything. The second is gold is all extraterrestrial. I learned that at the Perth Mint, which is one of the few places that assays and makes gold bars. So SpaceX might do a mission to Mars and then run into a gold asteroid. And Elon Musk, if he, it's international. I mean, he would own all the gold. He'd become the new central bank. And that gold could be 100 billion ounces.
What about the risk that you can manufacture it?
Correct. And the third is, of course, alchemy. Because look, if someone has discovered a way to knock an atom off lead to make it gold, they won't tell anybody. And there's just a whole bunch of gold supply coming.
So that's somewhat contrary.
Yeah.
The idea that it is not
we didn't
finite,
have lab-grown diamonds like we do, and they're pretty much the standard now for most people because they're like, why am I spending a bunch of money because something took them a lot longer underground? They just hyper accelerated the process and made the exact same diamond of a higher quality right here. I don't see that being too far-fetched at all. That still wouldn't give credence to backing it with gold, though. It just wouldn't.
Yeah.
It would just mean that there are just more gold and the price of gold would go down because there's more supply and demand would stave out. So To me, that's just never going to happen. We're not on a gold-backed currency. They can't. Federal Reserve wouldn't be able to do what they want to do. They couldn't print money out of thin air. So, not going to happen.
Yeah.
Too many powerful people would lose power.
Yeah.
To put it frankly.
Well, I mean, there is a battle of the powers right now.
What's going on?
So, I mean, I would never say never, but you're saying never.
I'm saying it'll never happen. Not in my lifetime.
Not in your lifetime.
Mm-mm.
Well, some positive news we'll talk about some positive and some negative news in the housing market. U.S. mortgage rates dropped below 6% for the first time this year and obviously quite some time. The question is will lower rates actually revive demand, or has buyer psychology, has supply continued to create this lopsided market that we are kind of seeing right now? We can talk a little bit more about that. Google searches for can't sell house skyrocketed to the highest level in over a decade. So
how?
We're seeing a lot of people that are struggling, and honestly, the supply is pretty wild. As of this last week, U.S. home sellers, and this is a pretty large talking point in my opinion, U.S. home sellers outnumber buyers by 600,000, which is an all-time high,
Holy cow.
beating the post-financial crisis. That's
a lot.
That's a big deal.
Yeah, absolutely.
I don't think that can be understated. I do believe that, and this is the question, what breaks first? Is it going to be price? Is it going to be expectations? Is it going to be liquidity? Right? There's a lot of stuff going on right now that is honestly a pretty perfect storm in the housing market that could lead to a major pullback in home values, in my opinion. Especially if we don't see the demand pick up and we do see some kind of cracking in homeowner income. And then we've seen delinquencies have peaked up to a 6-year high. So this is post-financial crisis. We're starting to see a couple of things that, in my opinion, are actually, I wouldn't say, sound the alarm. Like shit.
You almost said it.
I was going to say, I would just say that I am paying close attention to this because this could lead to some potential challenges in the housing market. And what we've seen is buyers just hit a record low of 1.36 million. Meanwhile, sellers are climbing fast. So we got nearly 2 million, we call it that 600,000 delta that I just mentioned, which is an all-time high. That's a huge gap. So we are seeing the housing market slowly show some cracks that I think, one, if you're an investor or you're a buyer, like there's some opportunities, not only right now, but I think there's going to be some significant opportunities here in the next 12 to 24 months, especially if we see any other cracks in the economy. We got people locked in 2 to 3% mortgages during COVID that are now putting their homes on the market. That's a fact, right? The only reason why they'd be putting their house on the market at a 2 or 3% mortgage is if they want to buy it and they're willing to pay a much higher mortgage rate and they don't care because they want that perfect home, or the alternative to that is because they are in some kind of distress and they need to cash in on where most people have a lot of their wealth in the United States, which is their home. So that is something that I am paying attention to. Now, on the other side, we've seen buyers kind of either sit on the sideline or just slow down. I don't know if that's because of the psychology of rates are going to continue to drop and we want cheaper interest rates. I don't know if that's because, affordability is just out of reach for so many people, which we've been talking about that on the podcast for quite some time. The average mortgage rate is sitting near 7% nationwide. Monthly payments on medium home price homes have nearly doubled since 2021. And first-time home buyers are somewhat priced out of the market. We've obviously seen that with the data of the average age of a home buyer being at its highest all time. So the affordability equation just doesn't work like it used to, and sellers are starting to compete with each other, right? What happens when you have oversupply and not enough demand? Well, if you really have to sell your home, you're going to see price reductions, and you're going to see people starting to devalue their assets a little bit to see if they can get the interest that they're looking for. And this is where some of these market corrections start to happen. This is what we see historically in housing economic cycles. So I do start to think, and now I don't think we're going to see implosions, right? I think really what we'll see is probably in certain markets, let's call it the Phoenixes, let's call it the Austin, Texases, the Miamis, that just went bananas over, the kind of post-COVID pocket of time. I think we will see many of those get hit first and hardest. Now, whether it spreads into, additional markets or it becomes more isolated, I think that's still the TBD, right? Whether or not this is something that becomes a much larger issue. So we'll continue to keep, a track on that. U.S. housing supply is moving in the wrong direction. New building permits for new homes declined 3.6% year over year. From the 2021 peak, permits have declined 350,000. New housing starts fell 6% year over year. At the same time, housing completions dropped 7.9% year over year to 1.5 million. The supply side of the housing market with new inventory isn't necessarily, keeping up with some of the, average demand that we've seen historically. But if we see, this delta that we're just talking about, maybe you don't need as many houses hitting the market, but I still do think we need more affordable houses. And that'll be something that will be interesting. Pending home sales fall to an all-time low in January. U.S. rents have fallen for the 32nd straight month. I think that's a positive thing if you're renting.
Yeah, inflation data.
And we've got 50 million boomers will die in the next 20 years at a rate of 7,000 to 10,000 a day. And guess what? 80% of those boomers, they own houses. So to your point, right, we'll either see a lot of millennials inherit that wealth from their parents. Here's another interesting fact, and not saying that this is something that we should be worried about, but Elon Musk said that the robots that they're building, Optimus, will build houses for cost within the next 10 years. So that would be interesting to see how that might, one, impact affordability in a good way, but also depending on demand and depending on, what kind of housing prices and the supply that's out there. There's a lot of variables in these equations, but overall, very interesting stuff to be thinking about. Now, as we wrap up today, is there anything that you're paying attention to as we round out this week with earnings and just kind of heading into the FOMC meeting in the coming weeks?
Nope. Just really want to see Nvidia. If they have good earnings tomorrow, it's gonna probably push the market up, and it could kind of break that, get us over that 7,000 hump and hold us there.
That'd be nice.
I'm hoping for that. So that's really what I'm looking for this week.
Cool. Well, as always, we appreciate you guys tuning in. We will continue to keep all of the headlines coming directly from the Money Moves mouth. Mr. Ryan Breedwell, Matt Aitchison, as always, we appreciate you guys tuning in. Don't forget to reach out. Text the word X-ray to 844-447-1555 to connect with Ryan and his team. If you are an accredited investor looking for passive income opportunities, text the word income to 844-447-1555, or you can text the word deals to that same phone number. And as always, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.
Cheers, y'all.